Hello, my name is David Dietze, and I am so honored to return to HTTV to have a program here with two esteemed colleagues of mine. What are we going to be talking about today? We're going to be talking about the economy, the markets, Summit, and you. But to help us do that, we've got two very special guests. And before I introduce them, I need to give a big shout out to two great volunteers to help make HTTV possible. One is my longtime friend, Frank Massiosi. The other is another great friend, John Ceruto. And of course, a special thanks to Amanda Olson for making the arrangements today. So let me introduce who we have to help walk us through this journey. Let me start with Jim Fleischmann. Jim, good afternoon.
Good afternoon, David.
Hey, Jim, talk a little bit. You know, I've had the honor of attending an investment club with you for nearly 20 years, listening to your take on the economy, on the markets. Talk about your background a little bit, where you live, and let's hear it for the audience.
Well, I live right here in Summit, but my background, I have been in the markets for 50 years, ever since I got out of the service, went to graduate school, got an MBA, started at a bank in Pittsburgh, eventually migrated to New York, where I spent quite a bit of time at Salomon Brothers, managing money for them. And eventually I moved to TIAA CREF, where I joined them as head of global research and ultimately became head of domestic equities. So I've basically been doing this for about 50 years.
Jim, you may be overqualified, but we'll somehow live with that. Now I'd like to introduce our other special guest, Fritz Schoenhut. Full disclosure, Fritz and I work together at the Summit office of PPAC Private Wealth, where we work with about 200 clients managing their finances and charting their financial planning path. I would say Fritz works for me, but so often I think I work for Fritz. Fritz, good afternoon. Tell us about your background.
Hey, David. So as you mentioned, I work with you at PPAC Private and Summit. Previous to that, I was at Goldman Sachs for about 6 years working in private wealth management. So very much in a similar capacity, working with clients, focusing on their investment management portfolios and their long-term goals. Previous to that, I was at Grant Thornton as a tax associate for about 2 years. So not quite the extensive background that Jim brings here to the table, but certainly some experience that I'm proud of. I currently live in Berkeley Heights with my wife and my son. So,
Great. Well, thank you both for joining us. Well, let's start with the broad overview. We're just so lucky that we're talking with one another without masks. And of course, there's a health crisis, and that has bled into an economic crisis. We seem to be recovering, but all eyes are on those employment numbers. We've got tremendous help from policymakers. Jim, what's your take as to where we are in the economy today?
Well, we're clearly recovering, largely because of the Federal Reserve, which slashed interest rates to virtually zero, which has allowed many businesses to continue to function. And of course, there's been tremendous stimulus package in the trillions, which have also added to corporations' ability and small businesses' ability to simply survive, but put trillions into the pockets of consumers. So essentially, while the economy was in a forced shutdown, it was aided and abetted by the federal government, fiscally and monetarily. We're obviously coming out of that now. The question is, are we going to be able to scale back in such a way that we don't have a bubble on the upside? Hopefully. We're clearly in a mode of recovery at the moment. The level of which is almost impossible to determine. There's tremendous pent-up demand, which is being satisfied now. How that manifests itself going forward, we'll just have to see. But we're clearly in recovery mode. It's in the United States and also here in New Jersey.
Yeah, and Fritz, I like Jim's take on this, but there are headwinds out there. I mean, we've got inflation, potentially higher interest rates. Talk a little bit about what you see as some of the challenges for the economy going forward.
Certainly, certainly. So as you mentioned, inflation rates are on the rise. We've seen numbers from April and May quite a bit higher than I think many expected. That said, the bigger concern then is how are the interest rates going to be affected by any rise in inflation? And right now, the Fed seems to be on a path of keeping policy a bit more easy and allowing interest rates to stay a bit lower. But how long is that sustainable? I think that's a bigger question on our clients' minds and investors' minds. So as Jim mentioned, we're in a bit of a precarious situation, being that things are certainly on the rebound. We're definitely a lot better off than we were a year ago, which may be the understatement of the day. But certainly, one of the major headwinds, looking forward is inflation and what impact that has on interest rates.
Let me just add on to that, because the issue of inflation is front and center right now. There's a distinct possibility that the inflation is a result of this tremendous explosion in demand caused by the easing of all the restrictions in the last few months, and that it will spend itself fairly quickly, and that we will go back to a more benign inflationary environment. I suspect that's the most likely case. Could be wrong.
Absolutely. So we do have our hardworking representatives in Washington, and they're in Washington and they're trying to help us. They've been spending a little bit of money, right? Fritz, talk a little bit about the fiscal stimulus and what effect that could have on the economy.
Yeah. So we've seen the effect it's had on the economy so far over the past year. This stimulus packages through COVID relief and such that has really helped buoy the economy during a very difficult time. Going forward, with additional stimulus potentially coming down with an infrastructure package as kind of also front and center or the major focus in Washington right now, that could certainly help the economy, bring more jobs to the construction sector and the industrial sector. But then we're in a scenario where potentially more money in the system, inflation rate stays a bit hotter than maybe most expect it to today. And so there's a lot of factors at play. Looking forward and considering all the stimulus that's out there and what we've already received. How that washes its way through the system and whether it's short-term inflation or potentially seeing a longer term, it's something that we're certainly keeping an eye on.
Jim, families and most companies, they can't spend money without first raising the money, but that's not always true when it comes to the federal government. They're talking about raising taxes. They may not raise taxes. Where do taxes shake out in all of this?
Well, I think taxes are a bigger factor for the stock market, actually, than they are for individuals. Because I think if there are any tax increases, there's so much pressure from the Republicans not to raise taxes at all that the likelihood of a tax increase on individuals at lower than what I think the president was talking about, $400,000. It'll be something like that. I can't imagine that there'll be any significant increase on the vast majority of individual tax payers. Corporations, a slightly different situation. Frankly, I don't think it makes that much of a difference. In the grand scheme of things, corporations pay about 6% of the overall taxes in the United States. It's really a very small portion. And regardless of what the administration does in terms of raising the marginal tax rates on corporations, very creative accountants always find a way, and lobbying groups always find a way to ease the tax burden on corporations. So I just don't think it's that big of a deal.
Fritz, one thing that is a big deal is the Federal Reserve. and I know that they have a very big two-day meeting that's concluding today, at which point they're going to talk about their plans going forward. Talk a little bit about what the Federal Reserve has done to prop up this economy and where you see them going from here. Can they continue to buy 120 billion of bonds each month, and when might that end, and what could the effect be when they start to taper back that bond buying and raise interest rates?
Sure. So a lot of eyes are on that press release later this afternoon. And what has the Federal Reserve been doing the past year? Well, they've been keeping rates low by buying bonds, as you've mentioned, and that's certainly helped out the broader economy, as well as anyone looking to, whether it was issue debt or if you're buying a mortgage, it's kept those rates low, which helped prop up the economy. That said, now that we're kind of on the right trajectory when it comes to the rebound in the global economy and especially here in the U.S., the question is, what do we do with these low rates that we're at now, and is that still a long-term plan? And it seems as if, from what we've been reading, is that certainly the Fed wants to keep rates lower for longer. There's still some room to improve, but that said, there very well could be maybe more communication from them regarding tapering back some of those bond purchases, expecting maybe interest rates to rise a little sooner than they had forecast a couple months ago, and that could have some real impacts to the equity markets, where you might see some some potentially harsher but more benign volatility, as we've seen in previous experiences where the Fed has announced maybe how they're going to taper those bond purchases. So it's amazing how much everything really plays together. But the Fed has been very active in their role and very helpful. But at some point the music stops, and so we'll just see from them what their plans are going forward.
It's not an accident that they call it a taper tantrum.
Yep.
When the Fed starts to taper and the markets go bananas.
Yeah.
But in fairness, I think if Jerome Powell were here, he's weighing your concerns on Wall Street versus the fact that nearly 10 million Americans that were working before the pandemic no longer have a job. Jim, that's one of the most important metrics in the economy, that unemployment rate. We do read that all sorts of employers say they can't find workers, but we have 9 million or so out of work. What's your view as to where we are on the jobs front?
Well, the Fed has a dual mandate. One is to maintain maximum employment. The other is to oversee interest rates and maintain the strength of the dollar. We currently have about 6% unemployment, which is actually not all that bad in the last 20 years. It got down to about 3% in the middle of the last decade, or around 2015, 2016. So at one point, I think unemployment was over 20 million, and it's come back significantly. And I think it will continue to improve over the next few months as nearly all states are beginning to lift the mandates on social distancing and opening stores and so on. Of course, that's on the assumption that we don't have a second round in the fall or a third round, I guess, of COVID. And fingers crossed, we're about, I think, over half the population has had 2 shots, and I think 2/3 of the population, or 180 million people, have had at least 1 shot. So I think the employment situation is gradually getting back to normal. As we see the service industries, restaurants, hotels, vacations, which we're starting to see pick up now, I think the rate will come back down to 4 to 5% relatively shortly.
So Fritz, we've talked a little bit about the national economy. Let's drill down to New Jersey and the local economy. Obviously, New Jersey was hit very hard by COVID. We have a diverse population. We've got a lot of movement back and forth between New York and Philadelphia. But of course, now we've kind of really opened up here. What's your take on the New Jersey economy and the local economy?
Yeah, no, I think looking back, it seems like New Jersey's done quite a good job in terms of the response and recovery, rebound from the COVID pandemic. Going forward, just some things that I've read, it appears that we have a pretty sizable budget reserve surplus that the governor intends to spend down quite a substantial amount over the next year or so. And so, that bodes well from an economic standpoint. And then just, maybe even anecdotally looking around and, in my neighborhood of Berkeley Heights, a lot of building going on, definitely a lot more activity at the local restaurants and, new housing apartments and complexes being built. So certainly from an economic standpoint, it appears that, New Jersey and the more local communities are rebounding well and are posed to continue to see some strong growth going forwards. Jim?
Yeah, just add a little bit. New Jersey is the 11th largest state in the United States. There are about 8.8 million residents. The gross state product is very big. It's close to $600 billion. So it makes sense that what happens nationally is going to be reflected pretty much in what happens in New Jersey. It's a very diversified economy, and I agree with what Fritz said. Anecdotally, everywhere we're seeing signs of recovery. There are people in restaurants are open. There's a lot of traffic, and it seems a lot more alike it did 18 months ago than it did 6 months ago. So I think we're starting to participate, like the rest of the country, in a recovery.
But Jim, one thing that did not help New Jersey, in 2017 we had tax reform, but New Jersey was actually dealt a blow by virtue of something called SALT. Can you explain what the heck is SALT and why should we care about it and what should happen?
Yeah, SALT is state and local taxes. That's what it stands for, an acronym. And they used to be deductible until the Tax Act of 2017, and now there's a maximum deduction of $10,000 against state taxes that are paid. And there was a concurrent cut in the top brackets, so even wealthy New Jerseyans probably didn't suffer too much. They just didn't benefit as fully as, particularly the upper income people didn't benefit as fully as the rest of the country or lower income people in New Jersey. I think the biggest effect that it's had in New Jersey is it is driving very wealthy people out of the state. They're moving to Florida where there's no income tax. That probably is not a good thing for New Jersey. And the state's been trying to deal with this problem for decades. The high tax rate in New Jersey, we have, I can't remember exactly, but there's like 565 municipalities in New Jersey, and they all have their own chief of police, and they all have their own fire chief, and they all have their own city administrator, and all the rest of the accoutrements that go with running a city, and it's expensive. And so the cost of government in New Jersey are fairly high. So it's not a plus, let me put it that way.
Yeah, that makes sense. So, taxes is something that is kind of outside our control, but managing our portfolios and trying to save enough so our kids can go to school, we might be able to have some retirement. Let me kick it off very broadly. Fritz, where are we in the market today?
Yeah. So, I was speaking to Jim before, and we're at a very interesting point in the market. To an extent, it's, from our perspective as investors and stewards of our clients, it's in some respects easier than it was last year, in some respects harder than it was last year. As of March 23rd, 2020, which was the bottom. It's harder in that, looking out a year, the odds of everything being up like it, didn't seem, but it ended up being last year is certainly not as clear. And but it's slightly easier because it's, you don't have clients that are, concerned with, the calamitous downfall of the global economy. When we're looking at the markets today, certainly valuations are stretched in some regards. I think, going back over the past several years, inflation being low, that was a way to justify valuations at the time. But now, if inflation is rising, is it intermittent? Is it lasting? That's a key question. But if it is longer lasting, then certainly valuations are deemed very stretched. But then, there's certainly areas of the market where there are opportunities still. And one area that we focus on is more in the value space. And after over a decade of value underperforming growth, we've seen a great bump and a reversal of that trend over the past, let's say, 9 months or so. And so while market currently is certainly we could be cautiously optimistic, there's definitely areas of opportunity that we're seeing.
Awesome. So, historically, one of the key ways to hedge stock market risk was to have a balanced portfolio with some in fixed income. But with the Federal Reserve having pushed interest rates down so low, does fixed income still make sense for the average investor, Jim?
Not to me. There's a very simple relationship. When interest rates are low, financial assets are elevated. When interest rates are high, financial assets depreciate. And you have interest rates at virtually all-time lows in the United States. The Treasury bill rate is zero. So short-term interest rates are zero. The 5-year rate is like 0.5%. The 10-year rate is 1.5%. And the 30-year rate is 2 something. So it's most likely that interest rates are going to go up from here, not down. So when interest rates go up, the value of bonds go down. So it's kind of a double whammy. You're getting paid very little to own the risk of bonds going down if interest rates go up. So I don't think bonds are a particularly attractive investment right now.
Okay. So, Fritz, should investors out there just put all their money in stock index funds? Is that the magic bullet today?
I would say no. When we look back and we were touched upon, the taper tantrum. I think generally investors have almost become so accustomed to easy monetary policy that rising interest rates is not only going to affect values of bonds, but also equities as well, and we'll bring in the term volatility again. And from an investor's perspective, or someone saving for retirement, what is their risk tolerance? Are they able to see their portfolio move around in 5-10% swings and be able to sleep well at night without getting panic and hitting the sell button? So fixed income, while the interest rate environment is certainly not conducive to the value of a bond going forward. If rates rise, then bond prices fall. Certainly, from our perspective, there is a value to holding some fixed income to kind of give you some of that sleep well at night money, in a safer asset that may not currently yield much, but it's also reduces the volatility in the portfolio and acts as a little bit of insurance as well.
Yeah. So, historically, I can remember someone like John Templeton said that the further afield you cast your net, the more fish you might collect. What's your thoughts on investing outside of our shores, and how would you do it, Jim?
Well, it goes to the whole issue of reducing the risk in the portfolio, which is what Fritz was just talking about. And that basically means diversifying your assets. That's essentially what Templeton was talking about by casting a wide net. And so there's more ways to diversify than simply equities and fixed income. Within equities, you can invest internationally. You can also invest in real estate. You can invest in gold. The idea that the more components you have in your portfolio, particularly that are not correlated, the lower the risk is going to be in the portfolio. So there are a lot of different ways to approach this problem. But certainly today, any investor, small investor, has the opportunity to buy a broad swath of international securities through ETFs, exchange-traded funds. Basically, they're indexes of international portfolios, and there are hundreds of them out there. But certainly, that is another way to reduce the risk in a portfolio, in any portfolio, by having a various component of equities, domestic equities, international equities, emerging market equities. There's an enormous menu, as well as real estate. And some people, my friend David here, for instance, makes the argument of holding a small percentage of the portfolio in gold, which has been, over long periods of time, a good store of value.
Awesome. Well, I want to thank both Jim and Fritz for spending time with us today, talking about the overall economy, drilling down to New Jersey, and then giving us some thoughts on our portfolios and the markets. With that, I would like to thank you for taking some time to watch our presentation here. We're honored as volunteers to share some of our perspectives with you, and I hope that you will continue to tune in for future shows on the economy, on the markets, and Summit and environs generally. Thank you very much.